All right, let's get going. I am pleased to present on this beautiful Tuesday morning Stephanie Sims, longtime friend and contributor to our community and to Startup Week. She's going to talk to us about busting fundraising myths today. This is a very, very interactive session. Stephanie, take it away.
Awesome, Kate. And thank you so much. It's always a pleasure to be here at Startup Week. What I want to talk to you guys about before we jump into the myths is who you are and what would make our time together a big win for you. A lot of times I find when I talk about fundraising, people have a very specific question or they have something that they're wondering about. So please make sure that what you do is you either write that down for yourself, or I'd love it if you would share in the chat what your big question is. Sorry, my allergies are acting up. What your big question is and what would make this time together a big win for you today. If you don't know where the chat function is, it is in the menu bar. You just type it in, and Kate, as I said, will help us get those questions answered. And we're going to make sure, since unfortunately we're not able to do our live demo today, we're going to make sure that we have plenty of time for all those questions. So please don't hesitate. There are no silly questions except the one you don't ask. So for those of you who don't know me, my name is Stephanie Sims, and I am the founder of Financeability. What I do is I teach entrepreneurs how to build an economic story that makes dollars and cents. I translate basically a decade of investment experience, investment banking experience, and a decade in a startup company that went from spin out technology to being sold to a publicly traded company. I translate all of that into something that's going to help you as an entrepreneur know your numbers, talk to the people who have the money, and find the resources that you need to grow. Okay. I'm not trying to impress you. I just want you to understand that the things I'm sharing are coming from a place of experience, and that really what I want is for you to have the right kind of resource and funding for your business to grow. Okay. So with all that said, what are the myths we're going to bust today? Myth number one is that all funding is created equal. A lot of people are like, I don't care where the money comes from. I just need money. Sometimes that attitude or that concept can actually hurt you when you're fundraising. So we're going to talk about that first. Second myth we're going to bust is that really what you need is more introductions to investors. A lot of times, if you don't know the kind of investors that you want to be introduced to, asking for introductions can also hurt you. Last myth that we're going to bust is that your pitch deck is the most important tool that you have to get a check. The truth is that your pitch deck is a part of what you're going to need, but there are plenty of other things that you need in order to make that deck and the rest of your fundraise a success. So let's go ahead and dive in. Myth number one is that all funding is created equal, or that no matter where you get the money, it doesn't change anything for you. Now, the reason that this is not true is because there are really three basic types of funding, three places that money can come from, and they all have a different impact on your business, as well as they all take a different approach to getting the funding. So over here on the left, we have bootstrapping. A lot of people are like, oh my God, I can't believe I have to bootstrap my business. I want you to understand very clearly that bootstrapping is actually building your business, and it's using your clients as the initial funders of your company. And there's great reasons to do this, not just because it helps you build your business, but because it also gives you more traction and more opportunities with the other types of funders. One of which is what I call borrowing. This is when you actually take out a loan, and there are lots of different kinds of those, which we'll talk about in a minute. When you take out a loan, that has to be repaid over time. So that's borrowing. You may have heard about SBA loans, revenue-based financing, and things like that. And then the last type of funding is what I call betting. This is where somebody actually becomes a part owner of your company and shares the risk with you. This is where angels, venture capitalists, private equity, and those other types of funders live. The thing to keep in mind is that one of these kinds of funding is not better than the other, is not going to make you more successful than the other. It's all a way for you to find money to grow your business. And one of the most important decisions you're going to make when you start to look for funding is where to focus your time and energy to get the right funding for you. because as anyone who's already raised capital can tell you, it can be a very time intensive and challenging process. So you want to be sure that you're focused on the place and the source of funding that gives you the best chance for success. So let's dive in a little bit more to these different types of funding, why they exist, and what they look like for your business. So bootstrapping, which as you can see is kind of the lowest risk and the lowest cost, is building your business. Now, the thing to keep in mind is it doesn't cost you anything to bootstrap because you're doing it yourself. Now, it doesn't mean it's easy because you are going to be out there looking for clients, trying to make sure that you keep your costs low and doing everything you can to generate more money inside your business that you can then use to grow your business. A lot of times this can also be referred to as kind of organic growth. It means you're not trying to grow your business necessarily quickly, but you're taking all of the capital that comes out of your business and you're reinvesting it into the business. The thing I want to point out here is that most businesses do have, if you look at a 5-year time span, do have about a 50% success rate, right? So it's not as if bootstrapping is some sort of panacea that's going to guarantee that your business is successful, but to the extent that you're able to consistently generate revenues and to control your costs, you're going to be in the 50% of businesses that continue to succeed after 5 years. When you look at borrowing, which is basically someone loans you money today, just like a house payment, just like a mortgage, someone loans you money today and you pay it back over time. This is where you get some outside capital, but with people who are a little risk averse, let's say. These folks, especially if you're dealing with banks and SBA lenders, are very focused on understanding the downside. They want to understand what happens if your sales decrease, what happens if things don't work out the way you planned, because it is their job to make sure that they get their money back. And because there's less risk associated with this particular type of funding, generally the return that they expect or the interest rate that they charge is relatively low. You can see rates on some small business loans from say 5 to up to 19, 20% if you're looking at more of a credit card or a line of credit type of financing. The thing to keep in mind is that this path for the lender, for the person giving you the money, is a lot safer because about 80% of small business loans are eventually paid back. When we contrast that with betting, which is people who are making equity investments in your company, those folks take a lot more risk because of the fact that they don't get any repayment until the time that you exit your company. So that could be 5, 7, in some cases 10 or more years. And so that's a very high risk proposition for them. In exchange for the risk that they're taking, they expect a much higher annual return on the order of 25 to 35%. As a rule of thumb, if you're thinking about taking equity financing and you look at what an angel or a venture capitalist is expecting to earn on your business, they're expecting to earn about 5 times the amount of money that they put into your company. But you have to remember that amount of money will also be diluted over time as you take on more investors. And so basically, when investors are looking at your business, they're thinking to themselves, if I'm going to invest in 10 companies, is this particular company one that I think could be in the top 20% of my investments and actually give me that 5 to 10 times return on my money? So the mindset of the people that you're dealing with when you're looking at borrowing versus betting is very different. And that means that the approach you need to take when you're preparing to talk to them and when you are actually in those conversations is very different. The good news is that the more experience you have bootstrapping, understanding not only your sales process, your clients, but the way that you deliver your product or your service, the easier it's going to be to talk to either lenders or equity partners. So don't view bootstrapping as like, oh my gosh, this is something I have to do. See it as an opportunity for you to learn more about your business, for you to actually be a good investor in your business so that when you talk to somebody outside, you are capable of explaining to them why it's a good idea for them to put their money into your business as well. So that's the landscape of the big types of funding, but I wanted to dive into a couple of things you may have heard of recently that might be giving you some questions, and you might be asking yourself, well, is this right for me, or should I consider this? And one of those is revenue-based financing. So I'm not sure if any of you are out there in the market looking at, for example, Shopify, which recently has created its own financing. If you have a Shopify store, they have a way for you to actually borrow money based on your sales through Shopify. There are other companies like the former Clearbank, which I think now is called Clearco, where essentially these companies will look at your sales, they will loan you money as a percentage of your past sales, and then they get paid back through taking a percentage of your monthly sales before you even get your money. And so in certain respects, especially if you have a product business that's sold online and you have growing sales, this can be a great opportunity for you because you know that your sales are continuing to grow over time. And so each month that you have growing sales, you're actually paying back more of the loan that you've taken out. And you're increasing your opportunity for a future loan because obviously those folks, once they see that you've been able to pay back the loan that they made you, are going to want to lend to you again. Now, the thing you want to keep in mind is that because this revenue-based financing is relatively new, there are some people who are perhaps a little less scrupulous who are charging much higher interest rates. I've seen some of these that had, a 50% stated annual interest rate on them, plus penalties and fees if you didn't make the minimum payments. I do think the other thing you need to be prepared for if you're choosing revenue-based financing is that some of these deals now are being stated not as a percentage on the amount that you've borrowed, but they're just being stated as a flat fee. So if you borrowed, say, $1,000, they're telling you that your payback is $1,200 or $1,400. No matter how quickly you pay it back, no matter how attractive your particular opportunity is. And so just be aware that in some cases, even though it is debt, these types of financing can be relatively expensive. Now, if it's going to help you grow your business rapidly, that might still be a better deal for you than trying to get an equity partner who would charge about the same rate. So the other one that you may have heard of that I want to be sure we address is crowdfunding. Now, crowdfunding is kind of being treated as a kind of behemoth, as a single entity, but the truth is there are lots of different types of crowdfunding. Essentially, what many of you may know is something called prize crowdfunding, which has been around for a while. This is projects or products that can be funded themselves because what you're doing is you're giving away or you're selling your product or service through a platform like a Kickstarter or an Indiegogo. In that case, essentially, you're really bootstrapping through crowdfunding because you're just using the crowdfunding platform as a mechanism to attract new clients who will buy your product or service. There is also, through the Jobs Act, now the opportunity for non-accredited investors, accredited investors can do it as well, but for non-accredited investors to invest small amounts in the equity of your company. So this would be where someone actually starts to own shares of your company. And instead of having to sell them a product or service to get them involved, you actually sell them a piece of ownership. I have seen equity crowdfunding platforms do deals as both debt. So there's an actual loan component where you're selling a debt instrument. And I've also seen them do it as equity, either through a convertible note or through a straight share offering. The thing I want you to think about if you're considering crowdfunding is that being on a platform is not free. So if you're going to do a crowdfunding campaign, you need to factor in not only the cost of what you're going to offer to your potential shareholders if you're doing equity crowdfunding, but also the cost of the platform. And that can usually be between 8 to, I don't think I've seen it higher than 12%, but that's an additional cost. And that money is taken out of whatever money you raise. So when you're calculating how much money you need, you want to be sure that you have enough in there to cover the cost of the platform itself, as well as any legal documents that will have to be prepared, because you are making a type of a public offering, and that requires some specific legal documents, which again have a cost associated with them. A lot of these platforms do have someone you can work with so that you know what that cost is up front, but you just want to be sure you're aware of that and that you're raising enough capital to cover those costs as well. The other thing I want to make sure you understand with crowdfunding is that these campaigns don't just happen. It's not like you show up, you post your campaign, and somehow the platform itself is going to drive a ton of traffic to your specific campaign. What you need to be prepared to do if you're going to use crowdfunding is to run your own very successful campaign to both activate the current supporters that you have and to do something to attract new supporters. And so I would suggest that if you already have a very large following and there's a lot of people who are in your network or who are in your kind of universe that want to support you, crowdfunding might be something worth considering. If, however, your current community is relatively small or you haven't really found the messaging that attracts people who don't know you yet, you might choose to wait for a crowdfunding campaign until you've built up that stronger community, because that's when you're going to really be able to maximize your opportunity in a crowdfunding campaign. So I want to make sure this is useful for you guys. And so what I've done is at the end of each section or the end of each myth, I've created a little action step. So for this action step, if we've busted the myth that all money is created equal, I would love for you to think about in the next year whether you're going to bootstrap, borrow, or bet, and just realize that you don't have to try to do all of them at once. You can focus on one for a specific period of time, and then you can always make a new decision, reevaluate after a year, and say, okay, great, now it's time for me to think about borrowing, to think about a crowdfunding campaign, to think about bringing on an equity partner. And so hopefully that was helpful. And I think we have some questions. Kate, you want to help us navigate any questions we've got about this myth number 1?
I feel you answered this, but if you have anything more, positives versus negatives of VC versus equity crowdfunding. I feel like you just did that, but maybe not.
Well, and I think we can add a little detail. So that's a great question. So equity crowdfunding depends on what you're doing, because there are certain platforms that are also focused on accredited investors as opposed to non-accredited investors. So if you were looking for what I would call, and what a lot of people call, smart money, meaning that it's somebody who's going to be a lot more involved in the daily operation of your business, you might be better served to try to get a direct investment from a venture capitalist, because that person might be a little bit more involved, and because you have a direct relationship with them, as opposed to them being one of perhaps hundreds, tens or hundreds of people who've invested through an equity crowdfunding platform. So hopefully that answered your question.
And then to fund or not to fund. Third startup, 2 bootstrapped with a ton of potential in education, have sales in K-12 growing organically now, looking to scale, looking for a strategy on when the best time to get the right type of funding opportunity is. We are in math recovery for post-pandemic losses. What to do?
Okay, so I think that's a great question. And actually, one of the myths we're going to bust in just a minute is going to address that, specifically when you should start to raise, how you should think about that capital raise. So if you bear with me, I'd love to tackle that one when we get there.
Okay. Any thoughts on how funding for a healthcare-based business might be different? How do you navigate funding when profits are not the primary goal of the business, by reducing the customer's cost long-term, but reducing the customer's cost long-term is the primary goal?
Okay, so interesting. I'm not sure that I understand that profits would not be the principal goal of the business, because ultimately your business needs to be profitable for you to be successful, regardless of what kind of funding you take, if it's a question of short-term profitability, like you don't need to be profitable right away, but I think long-term you want to think about how do you get to profitability, and ultimately how do you generate profits consistently and hopefully make them grow.
Great. And lastly, for now, and then we'll let you, then you'll move on. Is there a general range of necessary funding that would lead founders to use VCs, crowdsourcing, et cetera? For example, crowdsource for 10 to 50K or VC for 100 plus K?
Yeah, so I think this is a great question. And I think this is one of the places where people often spin their wheels and waste a lot of time. There are definitely different check sizes, which is basically what you're asking about, right? Different types of funders write different sizes of checks or make different sizes of investments. Venture capitalists are generally not looking to make investments of less than hundreds of thousands. And in some cases, a lot of the more well-known venture capital firms are looking to make millions. Like they don't want to invest less than, say 2 to 5 million in a particular company. So that's why quite often they may be a better fit as your company is growing. If you're looking for an initial round of funding, say in the hundreds of thousands total or less than $1 million, that's probably angel territory. Or if you were going to do a crowdfunding campaign, that would probably be more of a like a non-accredited crowdfunding campaign where you would get, friends, family, people who like your product or service to invest small amounts between say $1,000 and $10,000 each. So hopefully that answered it, but let's keep moving. And if not, we've got another couple of places where we can stop and answer more questions. Awesome. So myth number 2, and I get this one a lot. You need more investor introductions. So the number of times that I meet people, and I love these people, so don't get me wrong, and I want you guys to benefit from what other people are doing that you can avoid doing. I meet a lot of people and they say to me, oh, you help people get funding. Great. Can you introduce me to investors? And the very first thing I ask them is, okay, who's your ideal investor? And unfortunately, 9 times out of 10, their response is anyone you know, or someone with a checkbook, or I don't know, who should my ideal investor be? And unfortunately, asking for an introduction when you don't know who your ideal investor is can shoot you in the foot. Because the reality is that fundraising is actually a marketing process. And before you can be successful getting people to invest in your business, you've got to know who your ideal or your target investor is, right? Just like you wouldn't start out your sales process by just saying, hey, anyone can be my client. You can't start out your fundraising process thinking that any and every investor is a good fit for you. And ultimately, what happens is if you start talking to investors who patently aren't interested because they don't know your space or they write different check sizes than what you're currently looking for, you end up hurting your own reputation because people think, well, I have a website. Why didn't this person who's so interested in having me be an investor at least go see what kind of investments I make or understand what I've invested in recently? And my suggestion here is that before you start asking for introductions, you really want to develop a profile of who your ideal investor is. And if you really want to be successful trying to get introductions, you want to take it a step further and have it not just be my ideal investor does early stage investments in software as a service in the healthcare industry, for example. That could be an ideal investor profile. But you could actually go through and identify individual names of angel investors or individual groups who you believe would be a good fit for you, so that the next time you ask for introductions and somebody says, oh, great, who are you looking to get introduced to? You can make it really easy for them. You can say, well, I'm happy to forward you a list, or perhaps you ask a specific name. If you've done your homework and you've seen that the person you're speaking to is connected to one of your ideal investors on LinkedIn or AngelList or somewhere like that, it's always very powerful to say, oh, I see that you're connected with Mark Cuban, and that's probably not the best example, but with an investor, and I've been trying to get in touch with them. would you be willing to connect me? Now, just because you ask doesn't mean it's going to happen. But if you can demonstrate that you've already done your homework and that you know who a good fit for you is, then you are putting yourself in a very different category from people who are just out there asking for introductions to investors. I kind of liken this to somebody, and I kind of spoiled it when I said it earlier, but I liken this to somebody who is new in business and walks into a networking event and says, "Hey there, can you introduce me to clients?" Obviously, that's not going to be a successful strategy unless somebody already knows a lot about your business and knows who your ideal client is. And so if you can start to think about the fundraising process not as some mystic, magical, you have to get lucky and you just ask anyone and everyone, but if you think about it as an actual sales and marketing process, you're going to be a lot more successful, because being more targeted means that the shots that you get at conversations are going to be more fruitful and more worthwhile and give you a better chance at actually having that person invest, right? Just like you wouldn't want to talk to a client where there was no opportunity to make a sale. Why would you want to talk to an investor where there was no opportunity for them to actually want to invest in your business? So as you think about this, you don't need introductions. What you really need is a process, and you need a little bit of rigor or discipline for yourself. First thing you're going to want to do is you're going to want, like I said, to build this ideal funder pool early on. Identify the folks that you really want to talk to. And instead of saying, I want to get connected with them to pitch them, just say that you're building a business. Here's the things that have happened in your business. You're going to be fundraising at some point, and you wanted to talk to them to see if there was any reason to build a relationship and continue a conversation with them, right? We're going to talk a little bit about monthly updates later, but there's a secret weapon that you can use here to build those relationships so that when you actually are ready to fundraise, they're excited to hear from you instead of trying to remember your name. Once you are connecting with the right people, but not pitching them, you want to be sure that you're thinking about it as a partnership. A lot of times people are there and they're like, oh, please just get me connected with an investor and I'll do whatever I need to do. Well, that's not a good way to run your business. And that's not going to help you be successful over time if you don't know if that person's a good partner for you. So please be sure that as you're looking at your list of potential investors, you're also thinking about what questions you need to ask them and how you'd like to make sure that they're a good partner for you. Some people have the, would I invite this person? Would I enjoy being with this person over a beer test? And they're eliminating people who they don't feel they could go and have a beer with and enjoy their company. Another test that I've found to be useful is, would I pick up the phone and call this person if something went wrong in my business? Because that's when you need your investors the most, is when things aren't working. And if you're not comfortable and you don't have a relationship with them that would allow you to pick up the phone and say, hey, we just lost a big client, or something just turned out the way that we were not expecting. If they're not there to actually help you, then do you really want them as a partner? Because they may not be contributing in a way that's going to help your business be successful. The third thing I would think about as you're building your process is to be sure that you recognize that you're going to iterate over time, right? Don't feel like you have to wait to talk to people until everything is perfect. Think about scheduling your conversations once you do start pitching so that the folks who you're most excited about having as investors are a bit later in the process. So you've had time to refine your pitch. You've had time to get some feedback from other folks. You've had time to see what works and what doesn't, so that you're really in your groove when you talk to those folks who you would be very excited to have on your team. And the last thing I would say is, as you're building this process, you've got to create your own momentum. All too often, fundraising processes stall because you get some bad news, you get some rejection, and it's just easier not to do anything than it is to try to keep moving forward. If you can create an actual calendar for yourself that helps you understand, okay, here's what I need to be doing this week. And again, you treat it like sales and marketing. I'm going to block off, Wednesday morning, and I'm going to reach out to the 10 investors, sending them personal email updates or whatever it is. It's easier to keep executing like that than it is kind of in the void when all you're getting is negative feedback, and your temptation is to stop. So I would encourage you to think about this not as needing introductions, but as wanting to build a process and to build relationships with these folks so that you can actually benefit from their wisdom and they can help you be successful. So as we've busted the myth of what you really need is investor intros, I would really highly encourage you to start to build that ideal investor or funder profile. Now, I will say I am talking here specifically about angels, venture capitalists, because that's what most people think they need. This applies as well to anyone that you might be borrowing from. You can build an ideal funder or ideal borrower profile, or you can do this on your client side when you're bootstrapping. And that is your actual sales and marketing process, right? Like, who's your ideal client? And so you're going to be taking this process and you're going to be using it in all different methods of fundraising. So don't feel like you have to reinvent the wheel. You're just using a different target. Instead of it being, for example, your client, it could be, which bank or lender am I interested in? Or it could be which investor am I interested in? What type of investor is a good fit for me? So Kate, do we have any more questions that we want to tackle right now, or do we want to keep trucking?
We have a few. Number one, what are your thoughts about funding a lead investor for each of the rounds? About finding a lead investor for each of the rounds?
Yeah, so this is a big conversation because there's two schools of thought here. There's the school of thought, which is there's lots of people who will say that they're interested, but what they really want is for somebody else to lead. And then they'll make the decision based on the terms that the lead investor is able to negotiate. If you know that you're getting that kind of feedback from folks you're talking to, then you definitely need to focus on getting a lead investor. What you can do is identify people on your ideal investor list who have led investments before. You can find this out from Crunchbase, which is a really good resource. You can also find this out in your industry by looking at who has funded your competitors and understanding maybe who led those investments, so you get a good sense of who those potential lead investors will be.
Are the slides going to be shared? I know we're recording the session and we will be sharing that, but it will take us about a month. Are you planning on sharing the slides?
I'm happy to create a PDF and share them with you. Yeah. If you've got a place to put them, Kate, I'm happy to do it.
Yeah, you can just go on to Whova and attach it to the talk, and I'll walk you through that.
Oh, okay, perfect. So yes.
Then this is such helpful information. Thank you. And then, is there any investor matchmaking services?
So really good question. There are a few that are starting, right? So I saw, what's it called? Fundboard is one that I've seen recently. I have not talked to anyone who's used it. So I think at this point, it's maybe buyer beware. I don't have any idea if they're charging, what their fee structure is. I would suggest that you cannot outsource the actual discovery of who your ideal investor is. So you can have people who, once you know who you're trying to reach, help you reach those folks. But I think trying to outsource the identification of your ideal investor is always going to give you mediocre results. There's a few others. There's things like Signal. Again, you can use Crunchbase. And if you do have more detailed questions like that, don't hesitate. You can reach out to me on LinkedIn. I'm Stephanie J. Sims on LinkedIn. And if you want to DM me questions like that, I'm always happy to try to answer them or send you to resources I can find for you. Okay, let's keep trucking. So myth number 3 is that your pitch deck is what gets you a check. And there's a lot of focus. It's, this myth is pervasive because a lot of times in the popular press, this is what we hear. You need a stellar pitch deck. Look at Airbnb's deck. Here's the deck that Uber used to raise however many millions of dollars they raised, right? But what I want you to understand is that the pitch deck is just a part of the equation. And to be honest, it's in the middle of the process that you need it, not at the beginning. And so what I want to do is walk you through what you need to be successful fundraising so that you can understand that the deck is not your only asset in this process, And so that when you do prepare your deck, you know what to put in it so that you can actually be as successful as possible. So if you look at the fundraising process, the very first thing that you have to successfully fundraise is a credible milestone-based ask. And I'm going to dive into these in a little bit more detail as we go through, but I just want to give you guys the overview first, right? So first thing you need is a credible milestone-based ask. This means that you know how much money you're asking for, you know what you're going to do with it, and you know what it's going to do for your business, right? So knowing that you're going to spend it on hiring people is great, but that doesn't tell an investor anything. If you're going to hire salespeople that are going to double revenues, that is when investors start to get excited. And that is a credible milestone-based ask. Once you have your credible milestone-based ask, then you need to determine which type of funding fits your business best. First, you've got to decide, do I want to borrow or do I want to bet? Meaning, do I want to get an equity partner? And then assuming that you want to get an equity partner, you've got to determine, is my most likely funder an angel investor? Is it an early stage fund? Is it an institutional, like a venture capitalist? Is it a strategic investor? Is it corporate VC? So as you understand what kind of money you need and where you're going to use it, then you can start to understand who's the best type of person to provide it, or type of investor, I should say, because a lot of investors are funds, not individuals. Once you have those two pieces together, then you can start to put together a pitch deck that helps you identify the specific person you're going to talk to. So who to talk to, when to pitch them, and what you should say in that pitch. And that's when your pitch deck is useful, but only if you already know that you're talking to the right type of person and that you are confident in how much money you're trying to raise. Okay. So once you have your ask, you know that you've got the right funding fit, and you know who to talk to, when to pitch them, and what to say. You still have to prove that everything you said in your pitch deck is true before they're going to give you the money. This is when yes doesn't always mean yes, right? You can get a yes from an investor, which means yes, I'm interested, but that doesn't necessarily mean yes, I'm going to write a check, because you still have to prove that all of the things you told them were true. And once you've proven that through a process called due diligence, then you have to close the transaction, meaning you have to actually get the money in the bank, and you have to keep communicating with those investors in a way that makes them care about your company, so that when you want to raise additional capital, they're actually there and wanting to participate in the process. And they may be making introductions to other investors who can bring additional capital and help your business continue to grow. So you need a whole lot more than a deck, although a deck is a great way to encapsulate your current thinking about your business. And I encourage you to have one. You want to be sure that you're not just putting your deck together and thinking, oh, okay, great. I show up, I do my pitch, and someone writes me a check, because that's not the way it works. So let's talk through these different aspects of what I call the funding formula really quickly. So we mentioned a little bit about what a credible ask looks like. And one way to present that really effectively is to share, here's where we are today, with some data, right? We're growing at 25% month on month. We've just brought on 5 new customers. We've been able to expand into this particular new market with a conversion rate of 10%, right? Investors love data. So anything you can do to share where you are today, including that data, then you'd show them the future. You say, with the investment that we're seeking, we're going to be able to achieve $50,000 of monthly recurring revenue, right? Or whatever your number may be. So you set the milestone. And then you say, in order to do that, we're currently raising a round of X, right? $1.5 million or whatever the number is. And then you ask them if they can help. And quite often, if you ask if they can help and you give them options, you can be more successful, right? Can you share this opportunity with someone you know who might be interested, right? With just one person? Or would you be open to an additional conversation because you're interested in investing yourself? And so treating this credible ask as, again, a little bit of a formula, but making sure you're always exposing where you are today, where you're growing, and how the funding you're raising is going to help you get there is always going to help you stand out with investors. So that's important as well, because once you understand how much money you're raising, then you can start to determine who a good fit for you is. And determining fit is really about two questions. What kind of funding do you want? And then what kind of funding wants you? A lot of times I see early stage entrepreneurs really focused on venture capital because they believe that that's what they're supposed to do, but they don't necessarily want to sell their business. And so those two things are not compatible, right? Venture capital investors want your business to be acquired or to be taken public because that's when they make their money back. And if you don't want to do that, that's totally fine. It just means don't look to those folks for your funding, right? Likewise, though, if you know that you want venture capital and you're a good fit for them, but the amount of funding that you're looking for is very small, or you don't have a lot of traction, then angel or venture capital may not be a fit for you right now. In which case, it's better to focus on bootstrapping until you get that traction so that you're not wasting time and energy chasing money that it can't really be an opportunity for you because it's just not a fit yet. So once you understand your ask and your fit, then you want to figure out who to talk to, when to talk to them, and what you're going to say. We've already talked about developing this list of ideal funding partners, right? And again, I would get as specific here as you can. And as you start to talk to more people in your industry, as you start to talk to other investors, you'll be able to add names to that list, and you'll be able to even sort them by who you feel is the best fit and who you feel is maybe not a great fit, but you want to talk to them anyway because you always want to keep your options open. Once you have the list of ideal funding partners, you want to start talking to them when that next milestone is within your sight line. So if you're currently at $1,000 in monthly recurring revenue, you may be quite a ways away from 50,000 monthly recurring revenue. So it's probably not the right time to start talking to investors. However, when you get closer, say you're at 30,000 in monthly recurring revenue, that might be the right time to start your fundraising process and to start talking to them about making the investment, right? What are you going to say to these folks? The most important thing that you can say to investors is to help them understand why you're a good investment for them. This means that you have to know why you're a good investment, period, right? And that means you want to be, and we're going to talk about this in a little bit if we get there, you want to be the best investor that your business has, and you want to have an investor mindset about all the decisions you're making in your business, because then you're speaking the same language as the folks that you're trying to talk to. And you're not trying to figure out how they're thinking about things when you get in front of them, because you're already managing your business like an investor. Once you get an investor who says, yes, we're interested, you're going to go into something called due diligence. Due diligence is a process. It is not a checklist or something you can kind of give someone on day one and everything is fine. What I want you to understand about due diligence is that this is one of the easiest parts of the funding process to control, because you control all these documents, you control all of this information. And so you should do everything you can to have all of that ready before you start talking to investors about your fundraise to begin with. Because if you get someone who's interested, then they want to move into due diligence. If they wait for 3 weeks because you don't have your documents ready, all of the momentum you built up with your great pitch just dissipates. So I would suggest that part of your preparation for funding is also getting your due diligence process, your due diligence data room all set up and ready so that you can continue to move people through the process as quickly as possible. And I will say that a lot of deals fall apart here, either because somebody said something in their pitch that is actually contradicted by documents that they put in their data room, or because they just don't have all the data together and the investor kind of gets a sense that maybe they aren't as sophisticated or as mature as they would like them to be. And so they decide that they don't have a reason to invest. So the last piece of making sure that you get that you successfully fundraise is closing the deal and then communicating. As Lenny Kravitz so eloquently put it, it ain't over till it's over. That means up until the money is actually in the bank, you are still fundraising. That doesn't mean that you need to necessarily continue to do new pitches, but that means you need to maintain relationships with all of the people who are interested in investing in your business because you never know when something might change at the last minute. The other thing I want to remind you is that closing the deal is the beginning of your relationship, not the end. And this is where having a monthly update is going to be your secret weapon. And if you've already gotten in that habit before you started fundraising, you've built relationships with investors, you sent them a monthly update, and then they become your investor, and that beautiful trend continues, they're going to love you. They're going to want to help you in every way that they possibly can. And so there's no reason not to do this. What's your action step here? Build a fundraising action plan and keep yourself on track. Okay, Kate, have we got questions?
We have two, which maybe we can go through real quick.
Yeah.
Any local resources or leaders in the ICO space?
Oh, interesting. I don't know anyone offhand, but if you will ping me on LinkedIn, I know some people in other markets that I might connect you with that might be able to help you find somebody.
Okay. And the second one, what makes a good investment? I'm sure this involves more than just garnering a quick return from a monetary standpoint.
So this is a great question. And I don't know who this is, but I should pay them for the segue because that's what we're going to talk about in just a second. But what makes a great investment for an investor is something with a huge opportunity, right? So the potential to become $100 million plus business, and a team that is executing at a high level and that themselves are thinking like investors, right? This means they're checking the metrics, they're running experiments, but they're also taking feedback from the experiments that they're running and deciding, okay, great, I ran 3 experiments for social media ads. Facebook didn't work, LinkedIn worked, and Instagram worked. I'm not investing in Facebook anymore. I'm putting more money into Instagram and LinkedIn, right? Like that's the kind of investor mindset that is not only going to help your business grow faster because you're doing better with the resources you have, but it's going to help investors understand that you are a good investment. All
Great.
right.
Thank you, Stephanie.
You bet. So do we have time for a little bonus myth?
If you can do it in like 3 minutes, everybody's like, thank you. This is amazing. You're always one of our yes, go for it.
Okay. Let's do it quick. So, and this one I tell everybody, this is the biggest myth of all. Do not fall for this one. You do not need funding to be successful, right? I hear this all the time. Well, if I just had money, then my business would be great. Well, guess what? Anytime you find yourself saying, if I just had money, everything would be great, I want you to do this exercise. If I had all the money I needed, would I know exactly what to do with the money? So where to invest it in my business and what success looks like for that investment. I think there's a lot of people who can answer yes to question 1, right? Because maybe it's, I'm going to hire a salesperson, but they don't really know what return they should expect from that investment. And that is the key to being a good investor in your own business. Once you know not just where you're going to put the money, but what success looks like, then you can start to work miracles in your business because you can start to decide for yourself what to do and what to stop doing. Okay? I'll leave you with this thought. Money is only a tool. I say this, I think, to every audience I ever talk to. Money will not make your business successful, but you can do it. If you dig into the numbers, you start to become a good investor, you can make your business successful and you will always be able to find the resources you need. You'll be amazed at how creative you can get.
Thank you, Stephanie. Fantastic. Everybody, maybe you can go on Hoover and interact with people. There's more questions coming up.
Sure.
If you have some time.
Okay.
And you can also find her on social, LinkedIn. Everybody's, it's blowing up. Everybody loved your talk.
Oh, okay.
And then make sure to join us in how many minutes? 8 minutes for a panel about social good. Thank you, Stephanie. We so appreciate you.
Of course, it was great. Thanks everybody for being here.
Take care.
Okay.